Are you ready to set sail on a smooth income generating journey in 2024? Yes, we are talking about the REIT sector. It's no secret that the REIT sector has taken it on the chin last year in 2023. So let's rewind a little bit, revisit the roller coaster ride that was 2023. It was a challenging year for REITs. The sector has been battling headwinds from surging interest rates and high inflation. Here at the Smart Investor, our house view is that we see this phase as a temporary setback. With rumors of interest rates hitting their peak, the REIT sector has rallied somewhat, already achieving an impressive 7.4% in total returns last year. So the question tonight is there still potential for REITs in 2024? The short answer is a resounding yes. We firmly believe that this sector could be a game changer for your portfolio. In fact, we are so confident in this sector's potential that we are backing our conviction with action. So here at the Smart Investor, we have committed to buying 6 REITs in the first 6 months of 2024. We are allocating 10,000 Singapore dollars in cash through our flagship service, the Smart Dividend Portfolio. Royston is the portfolio manager of the Smart Dividend Portfolio, and he will be looking out for at least 6 REITs to add to our portfolio, 1 a month minimally, for the first 6 months of 2024. And in our webinar this evening, we will cover why we are investing in REITs in 2024 and why you should too. And more importantly, how to identify REITs with the potential to magnify your portfolio's returns. So there will be 2 short presentations, and then we'll close off tonight's session with the Q&A. So ask us your REIT-related questions, please. Again, before we begin officially, if you like more REITs-related content from us, we have a free mini report that's available for download. Let me share the link in our chat function. So you just click on the link, you can download the free report. You can, there's so much more REIT-related content in that report. Again, this session is recorded and we will be sending out a copy of the recording to you, hopefully tomorrow. You can send in your questions at any time this evening. We will again close off accepting new questions in the last 15 minutes. So I do encourage you to send in your questions early. Just use the Q&A button at the bottom of your screen and type it in. So with that, without further ado, I will hand off to Chin to make the first presentation. Chin.
Hi, everyone. Okay, everyone can see this, right? All good? Okay, I see Benny Tay raising his hand. Thank you, Benny. So firstly, good evening to everyone, and thank you very much for spending a Tuesday evening with us. Really happy that everyone took time to join us today, right? I'll start by giving a brief introduction about myself. So I'm just going to share 3 things about myself, and then I'll get down to the presentation proper. And this for the benefit of people who might not know who I am, right? So this is myself with my 2 co-founders, Joanna and David. Now, you will know David for his love of dividends, which I'm sure he has shared over TV, over radio, and whatever channel there is really, because he's quite a media personality. And every single segment, he won't stop talking about dividend stocks because that's what he loves, right? And what you may not know is that David and Joanna, they've been in the investment scene locally since 2013. They're the first 2 employees in the Motley Fool Singapore. They were the 2 employees who set up the Motley Fool Singapore from ground zero. So from literally nothing into something, right? And so we have been around for quite a while, but not and we've been involved in the local scene for a long time. I just give you a small snippet. When David joined, the lot size in Singapore was still 1,000, and David actually helped lower it to 100, right? So I I joined a year later. Prior to that, I was already working with the Motley Fool US. And in 2015 was a big year for us because that was the year where we launched our first subscription service. I still do check on the results because enough time has passed. We're now in 2023 and I can look at the results with a bit of pride because I do feel we did quite well for the service itself, right? Unfortunately, in 2019, the Motley Fool Singapore decided to exit Singapore. This is, I have to clarify, this is purely a business decision. And in a way, as one door closes, another one opens, right? Because when that door closed, we found that there were a lot of members who were still with us and still wanted to hear from us, which is why we felt that our job was not done. And in 2020, we started the Smart Investor, the three of us, and we've been doing it ever since, throughout the pandemic, the recovery, everything, right? So really happy to be here doing this today. Now, let's talk about REITs. I think that if you look back at the last 5 years for the REIT sector, and this is the index, the S-REIT index or Singapore REIT index, it's a good representation of how REIT prices were behaving the last 5 years. You'll find that during the pandemic, there was a significant fall, followed by a very sharp recovery, somewhat flat, and then around 2022, when interest rates started rising, REIT prices started to fall, right? And in recent times, because there's some optimism that the Fed might actually cut interest rates, you see the prices start rising again. So I think if you want to categorize things, we are sort of in a mixed situation now where things are, I would call, a bit confusing, because there is some pessimism, then there's also some optimism as well, right? And during times when things are confusing, what I found useful is really to cut through the noise, right? Know what to focus on. And that's really important because to me, REITs has one job, just one, nothing else. The one job REITs have is to pay you a dividend, right? If you're a unit holder, the REIT's job is to pay you a dividend. Now, this expectation is really important because sometimes I see people buying into REITs thinking that they're going to get capital gains, they're going to get income and so on. That's nothing wrong with that expectation, but your key expectation should be that it should pay you a dividend, right? And in David's own words, he says, and you can write this down because this is really important. He says, you're not buying a stock, you're buying income. Okay, let me repeat that again. You're not buying a stock, you're buying income. Now think about that for a moment, because what David's focused on is not so much about how high that stock can go. What he wants is the income which the stock pays. And if that income can grow over time, the stock price will follow, right? So this is a very fundamental understanding to have the right expectations. Otherwise, if you go in with the wrong expectations, you're thinking of getting like a 20% gain in the next 6 months or what have you, I think you will be disappointed, right? The key here is really about income and income alone. So the natural question is, what happened in the last 2 years or since 2022, which caused REITs to fall as what I showed you, right? Many people will look at what happened, as I showed you just now. Interest rates go up, REIT prices go down. So it seems to be connected, right? There, interest rates go up, then the unit prices of all the REITs all fall. They're connected. I understand what's happening. But is that really true, right? I think that there's more nuance to it. And the one thing I want to point out is unit prices have risen before while interest rates have gone up. And in particular, if you look at 2015 to 2018, right, during this period, interest rates rose from 0 to 2% at over 36 months, right? Now, this 36 months is really important. Keep that number in mind because I'm going to refer back to it later, right? So during this period, this 3-year period, where interest rates rose gradually, right? Important word, gradually. unit prices rose. DPU, or the distributions, rose. So it's not true that because interest rates rise and therefore unit prices fall. That is not true. I just showed you why it's not true. Example here, right? A 3-year period, long enough period to say so. So if that's just the case, then what really happened in 2022? So I think, and this is my opinion, the big difference is not just that interest rates rose, is how it actually rose. Because the increase happened in less than 6 months, it's already 2%, right? In 9 months at the end of 2022, it's already more than 4%. And these are significant change, which I will touch on later, right? This is a world of difference, how different these are. This is 6 months, and previously, as I mentioned, was 36 months. This is very gradual. This is supremely sharp. The change is very significant. And the question really is, how does this impact REITs then? And I want to give you this diagram in your head so you can visualize everything, right? What does REITs do? REITs help you buy properties which you can't buy alone as an individual investor. So supermarkets, hotels, hospitals, things like that. It comes with REIT managers, which help manage all these properties. Now, they need money to buy all these properties, right? So they need to work with banks. They need to work with unit holders like you and me to raise money to be able to buy these assets. Now, these assets then generate rental income. And with the rental income, part of it will be used to pay interest. Now, I capitalize the word interest here because unlike paying for your house loan where you pay for interest and capital, REITs typically only pay the interest, right? Which is another way of saying that REITs always have debt, okay? Now that you have this entire picture in your mind, let me tell you why a very sharp change in interest rates cause all these problems, right? Firstly, loans, right? If you remember how long it took for you to actually get a HDB loan, it wasn't immediate, right? When you try to get a HDB loan, I remember sitting at DBS for inordinate amount of hours. It took maybe weeks, if not months, to actually get all the loans and everything prepared with documentation and so on. Now, imagine if you're doing it at a much larger scale for huge properties. This doesn't happen immediately. It takes time, right? It takes time. Now, buying a property, even if you're buying your own property, it also takes time, right? It's not an immediate process. It may take 2 to 3 months. And then, now imagine if you have to buy something like a hospital or a huge office building, the due diligence is going to take time. Again, it takes time, right? Now, what about signing up leases, right? When you sign up tenants for all these types of properties, right, it's also not immediate. You need time. You need to select the right tenants. They need time to come in to renovate the place. And again, all this process needs time. You sign leases, which are 2 to 3 years, and you can't simply just change the terms as you like, right? All these needs time. So 3 parts of the process, 1, 2, and 3 needs time, correct? But this impact on interest payment is immediate, right? When interest rates rise the way they did in 6 months, 2%, in 9 months, 4%, the rest of the processes, 1, 2, and 3, can't adjust fast enough to actually compensate for this increase, right? There are other impacts, of course, but generally speaking, the impact on the interest payments is so fast that even if you try to adjust, you can't adjust fast enough. You can't simply go to your tenants and say, hey, now you need to pay me more. Why? Because interest rates went up. You can't do that, right? So this, in my mind, creates the stress, right? And in that sense, I think that there are 2 things I want to focus on. The first thing is about debt and how you can limit some of this interest payments, right? And this is a slide from CICT, or Capital Land Integrated Commercial Trust, super long name. I just call it CICT, right? I'm going to use this example, and I want to focus on one single factor, which I think a lot of people usually don't focus on when it comes to trying to limit the impact of interest rates. And this is it, right? Average maturity for 4.5 years. And if you want a more detailed look, you can see that the debt from year to year, only a portion of the debt comes due. So you have 15% in 2024 and 13% in 2025. And what this means is that every year, only a portion of the debt is being refinanced. And if this debt is using low interest rates, then when you refinance, it becomes higher interest rates. There is some impact, but you're able to limit it because it's only 15%, right? And what that helps you do is it gives you time to actually do something else for your top line. You try to adjust your rental rates to fit the current scenario, right? And I think that this does help limit the amount of impact for interest rates. And for the case of CICT, I think they are probably one of the ones who are better able to manage it, right? So this is just one factor. I'm not saying buy CICT, by the way. I'm just saying there's one factor which is working for CICT. Now, I want to close with growth, right? And there's 5 ways that a REIT can grow, right? So I already talked about keeping costs intact. Now let's talk about how the REIT can grow itself. So I'm just going to run through this real fast because Royston is going to cover this in more detail. First way, asset enhancement initiatives. It's basically, layman terms, you renovate. After your renovation, it's larger, it's nicer, people pay more for that space. Now 2, capital recycling. You sell off your older property, you buy newer ones with better yields. Thirdly, rental escalations, self-explanatory. 4th, acquisitions, self-explanatory again. Last is redevelopment, meaning you tear down the entire building, you redevelop it into a new, better, larger space. But I think the one factor which supports all 5 growth initiatives just now is really about a good sponsor. And because my time is running out, I'm just going to zone in on one example, which gives you a very clear idea of what a good sponsor looks like, right? So I'm going to show you 2 photos, and I'm going to give you 10 seconds to think about it, right? So on the one side, there's Far East Plaza, and Far East Plaza was built in 1982, right? And on the right-hand side, you have Plaza Singapura. Now, I'm just going to give you 10 seconds to think, is Plaza Singapura younger or older than Far East Plaza, right? 10 seconds. I think the Smart Dividend portfolio members already know this, but I think it's, for me, a really interesting example to share. Okay, 5, 4, 3, 2, 1. So guess what? Plaza Singapura is actually 8 years younger or older than Far East Plaza. So you have a building over here, which is 50 years old, and yet you can see it's night and day, the difference between these 2 malls, right? And I think that says a lot about the sponsor or the person managing Plaza Singapura itself and the kind of expertise they bring to keep the space modernized, even though it's 50 years old. So I'm going to end right here. I'm going to come back for the Q&A later, but I can hand over now to Royston to talk in more detail about those initiatives I mentioned. Thank you.
Thank you, Chin. In the meantime, we have already received so many questions. Thank you for asking us all your questions. So keep the questions coming in. We will try our best to answer as many as we can, but just a quick comment that we are unlikely to be able to go through all the questions this evening. So maybe in Royston's presentation, he will already answer some of the questions. So, Royston.
Okay. Hi, good evening, everyone. Thanks for joining the webinar. So I'm just going to share my screen now. Okay. So earlier, I think Chin mentioned about REITs and the ways that they can grow their DPU. So I think you might be curious to know, if you look at last year, REITs were actually, they actually had a very bad time, right? So the question is, which REITs have actually managed to grow their DPU last year? I think it's quite a rare bunch, you might be thinking, and you're right. So one of them is Mapletree Logistics Trust, and another one is Parkway Life REIT. Okay, so what is the increase in this case? So as you can see here, the DPU for Mapletree Logistics increased just a tiny bit, 0.5%, okay, for the first half of 2024. And for Parkway Life REIT, for the first 9 months of last year, it actually managed to increase its DPU by 2.8%. So you might be thinking, wow, that's quite amazing. I mean, these REITs actually managed to grow DPU even though interest rates rose at one of the fastest rates ever in history. So how do they actually do it? Okay, so there are 5 ways that REITs can grow their rental income. And I think Chin had already mentioned these 5. So I'll just go into detail for each of these points here. The first will be acquisitions. So acquisitions basically help to boost the REIT's DPU, distribution per unit, as well as asset base. And they are usually financed either by debt or equity, or sometimes a mix of both. So for equity, it can be a private placement, which is a placement of shares to raise money for the REIT, either that or a preferential offer, which means that unit holders can also participate by purchasing additional units of the REIT so as to raise money for the REIT. What are some of the examples of acquisitions that have taken place? So I think a more recent one, which we saw sometime in the middle of last year, is actually Mapletree Industrial Trust. So what the industrial REIT did was it acquired a data center in Osaka, Japan. This was its first foray into Japan, actually, because right now it only owns data centers in the US before this purchase. So what is the effect of this purchase? It increased DPU by 2.4%. So you can see here the very obvious effect of the acquisition is that the REIT can increase its DPU. Okay. The next will be asset enhancement initiatives, or AEIs, which Chin mentioned earlier, is to renovate. Okay. So of course, renovation helps to improve the attractiveness of the property so that it can generate higher revenue. So it can be also a refurbishment or a reconfiguration as well. So these are all the different types of R words that can help to make the property look better and also more attractive, so that tenants are not only willing to take up space in the property, but they're also willing to pay more as well. Okay. So the AEI may boost the REIT's operating metrics as well. So maybe initially the property had a very low occupancy, but after the AEI, it will enjoy higher occupancy. So some examples of AEI is one that OUE Commercial REIT recently did, which is to rebrand and upgrade the Hilton Singapore Orchard Hotel. So this is the hotel that's located just near to Takashimaya. And what the REIT actually did was it actually had a rebranding. It did enhance the asset, and eventually revenue per available room increased by 16.5% year on year for the first half of 2023. So that is a very positive effect of the AEI for the REIT. And there's also an ongoing AEI. So if you actually live near Tampines, you know that Tampines One Mall is undergoing an AEI or renovation. And a lot of new tenants are moving in, and they're also shifting some of the old tenants around. So what happens is the renovated units was actually slated to open last month. And I think the AEI should be more or less completed now. It's already January 2024. So these are some examples of AEI that REITs have undertaken that can actually improve the attractiveness and quality of their property portfolio. So next, we look at positive rental reversions. So what is rental reversion? It simply means the change in rental rates when leases are renewed. Okay. So of course, if you have an increase in rental rate, it's considered a positive rental reversion. Negative means that you actually pay less in rental, and well, no REIT wants that. So what are the factors for positive reversions? If you have high quality, well-located properties and reputable sponsors, then there's a higher chance that your tenants actually are willing to pay more in terms of the rental rates that when they renew their leases. So these are some examples of positive rental reversions. Again, we look at Fraser Centrepoint Trust. As you can see, it owns this whole list of malls here. Some of them include Causeway Point, Century Square, and White Sands. So you can see that it actually experienced a 4.7% positive rental reversion in fiscal 2023, which ends 30th September 2023. So that's good. It shows that this REITs properties, or rather their malls, are actually highly in demand. So a lot of tenants, when they renew their leases, they're willing to pay higher rental rates. Okay, and there's also something called rental escalation clauses, which is similar to positive rental reversions, but the difference is that these are actually inbuilt clauses already factored into the lease agreement. So imagine the REIT, which is the landlord, signs a lease with the tenant. So within the lease agreement itself, it already says after 1 year, your rental rate will actually increase by X%. And these usually factor in the inflation rate or a similar measure. So if let's say inflation rate is pretty high, it was around 3.2% as of November, then basically the lease will incorporate this increase into the rental rate, and the tenant will have to pay more when they renew the lease. So this actually is a good way for the REIT to provide organic rental growth. Okay, this example here is for Keppel DC REIT. As you can see here, more than half of its portfolio has built-in rental and income escalation clauses. So this actually helps the REIT to keep pace with inflation, because even if inflation is high, the tenants will have to pay higher rentals based on these escalation clauses. And finally, we look at developments or redevelopments. REITs actually are allowed to do a little bit of development within their portfolio. So what some REITs do is they actually purchase what you call a greenfield site, or basically a piece of land. And from there, they can actually develop an income-generating asset. Okay? So of course, it will take time to generate this income, because they will have to build the asset from scratch. Okay? So it's different from the acquisition I mentioned earlier, which is of completed properties. So the redevelopment of property usually can help to increase its plot ratio and gross floor area. So this is to take an existing property and really spruce it up, maybe over like 1 or 2 years or even longer. If you increase the plot ratio, then basically you can have a larger gross floor area and more tenants can move into the property. Okay? And of course, when you have more tenants, that will bring higher rental income for the REIT. So there's a very recent example here of Maple Tree Logistics Trust, where it's developing, or rather redeveloping, a property at 51 Benoy Road. As you can see here, the gross floor area will increase by 2.3 times. So from 391,000 square feet, it'll go to 887,000. That's really a big jump, and it's going to bring in significantly higher rental revenue for this particular property for the REIT. But it will only be completed in the first quarter of 2025. So I think, if I'm not wrong, this probably started sometime in early 2022. So it probably takes about 3 years for them to completely reconfigure the building. Okay, so basically those are the 5 different ways that REITs can grow their DPU. Why do they want to do that? I mean, there's actually one way for them to mitigate the decline in DPU that because of higher interest rates. Okay, so with that, thank you. And the usual disclaimer applies. Okay, all the REITs that were mentioned during this presentation is not any endorsement for the REITs or any recommendation on our part. Okay, okay, and then now we can move on to Q&A.
Thank you, Royston. I was trying to unmute myself for quite some time. Well, we have quite a few questions that have just come in. What I've done is to try and group all the similar type questions together. Again, just to let everyone know, we are recording tonight's session, so you can catch up on this recording if you miss out on Chin and Royston's presentation earlier. So, okay, the first type of question is, can I hear from Royston and Chin on what do you look out for when you buy REITs? So maybe Royston just presented, so I'll just ask Chin first. Chin, you're muted.
Oh gosh, this unmute bug is contagious. I would really go back to the presentation just now, where I spoke about the job, that one job which REITs have, right? And that is to provide you with income. So I think that if you think along those lines, what can a REIT do to actually ensure that that flow of rentals is sustained? How do we know that that is sustainable? And if you look at the different factors which Royston actually shared, inbuilt escalations, for example, that be one factor which helps sustain and grow the your rental without doing anything, right? These are inbuilt and will happen every year. So I think that the most important thing is really having the right expectation, focus on that sustainability of income. And then I think the factors will just all fall in place, in my opinion.
Okay, I think I'll have a go at this question as well. What attributes do I look for, right? So I think Chin mentioned earlier the presence of a strong sponsor. So I think that's something I'll look for. It has to be a reputable sponsor. It has a track record of developing, let's say, a very large portfolio of its own properties. And it also has the expertise to carry out, very good acquisitions as well as AEIs. That's one factor I'll look at. Second factor is probably how consistent is the DPU. So of course, if the DPU is really volatile, that shows that there's probably some issues with the REIT. And of course, we have to discount the fact that there was COVID-19 recently, and a lot of REITs, were affected by that. But in general, if we see, like a smooth slope upwards, that's something good for me, that I'll actually take note of. And of course, probably one more factor is the REIT has to have really quality properties, which you can see it in the metrics. Like high occupancy is one thing, positive rental reversions is yet another sign, and the third is probably high tenant retention rate, which means tenants just keep coming back because they really like to deal with the landlord, because they feel that this landlord is just, the properties are just so good, they have to be in them.
Thank you, Royston. Somebody else asked, where is David Goh? By the way, he's out of town, so that's the reason why he's not here this evening. Okay, next question is, when is the best time to sell our stock to take profit? Or are we going to hold on until the next crisis? And a second question along these lines is typically how long would one hold on to an acquired REIT? I think this is a very interesting question because always we talk about, what stocks are good to buy, what should we buy, when should we buy it, how much do we buy? But then, after all of us are investing to better our financial future, right? So then when do we then take profit? I think that's the beauty about dividend stocks, and in particular, what we are doing at the Smart Dividend Portfolio. I'm going to let Royston and Chin talk about this a little bit more, but yes, I already sort of gave the answer. Dividends.
You want to
go first? Okay, I'll go first, sure. No
okay, Royston, go first.
Okay. I mean, like for myself, when I buy REITs, generally I do not sell at all. I mean, yeah, so far let me try and think, but I don't think I've ever actually sold a REIT since I started buying them. It's always been buy.
Until death do you buy.
Yeah, I mean, I bought my first REIT, that was in 2004, Suntec REIT. So that was way back. So I mean, there's a very good reason for this. Is because, I mean, like Chin and Joanna mentioned, REITs are basically for income. So as long as they fulfill their job of providing me with the income that I seek, then I don't see the reason to sell them. I mean, unless you're telling me the REIT suddenly stops paying a distribution, then that could be a big red flag for me. Or if distribution gets cut really, really drastically, then yes. But otherwise, I really don't see any reason to sell, any REITs, or even like sell any stock which is doing badly just because, of temporary share price fluctuations, which are actually quite normal part of the stock market.
But there's also the profit part. It's not just about a stock doing badly, but there's also because something is doing well. For example, if you bought into a REIT and it has gone from, hypothetically from $2 to $4, you've already doubled. Then do you want to sell it and take profit, or do you continue holding on to it? In that situation, what would you do?
I think for me, I'll still continue holding on to it. I mean, we have seen like some REITs go really, really high. That was in 2021, if I'm not wrong. But I mean, as long as they continue paying their income, I don't see any reason to sell, because when you sell, you also have a problem of like when to buy back.
If REIT which has gone up by 3 times, 4 times.
Oh yeah. I mean, then also another question is, how do you reallocate the money? So if I think that the money actually sits very well in the specific REITs that I've already bought, then basically I'll just stay vested in them. Don't want to shift around.
Yep. So I just mentioned 2 things here. Number one, I think he mentioned crisis, right? And I can understand where the question comes from, because have gone through like seemingly crisis after crisis. They are actually quite spaced out. We had 97 Asian financial crisis, dot-com crisis. We have 2008 great financial crisis, then recently the pandemic and so on. So I do understand where that question comes on. If it feels bad when you hold and then a crisis, everything drops and so on. There's really two ways to look at it, right? And this was actually a question which my ex-boss asked me like 2 months ago, and because he had a lot of REITs and he was feeling a bit down because until recently, REITs were quite down by quite a bit, right? And my answer to him was really, I bought REITs for the income, right? And so long as the income is sustained, I am happy with it, right? That was my purpose. But I'm speaking from a perspective where I'm a so-called wage earner. I'm still earning income. I still have money coming in where I can invest new money if the REITs fall and so on. But for the case of like retirees and so on, where you might not have money coming in as much as a regular income or salaried person, then maybe you might want to think about how much you want to allocate into REITs and how much a comfortable holding for the long term. Because I think, as Royston mentioned, if you keep on selling and buying, then I think it's quite hard to make money from REITs. Because as I mentioned, and this is my second point, the key here is really about what REITs are for. And it's mainly for income, right? And if you're happy with that income, then in my eyes, just let it continue paying those DPU. I bought REITs very deep into the great financial crisis, and that has actually gone up by about 3 to 4 times, right? But even then, I don't see a reason to sell it, because it has been I think it's one of the few REITs which has increased its core dividends in the last, since 2009, right? Without fail. Any guesses?
2007.
Very easy. Yeah.
Well, I think that there are a few, it's not just about selling or taking profit, or it's not just about taking profit, right? It's about, if you sell, what are you going to do with the money, right? If, for example, I think there are instances at the Smart Dividend Portfolio, and we are looking to do that this year, which is to sell a couple of stocks or a few stocks within our portfolio. And there are reasons behind that, which we will explain to members when we take that action. Right. Sometimes it's because maybe it's the business decision or rather the business case that was originally when we bought the stock does not already hold, right? Sometimes it's that you want to put your money to better use somewhere. But if, from what I'm hearing, from what you're saying, then if a REIT is already giving you that income, then that is a great continued use for your money. On a personal level, I love, I think we were talking about this internally as well, right? I love all these dividend stocks. I have a bank account just especially for dividends, and then you see all the green pluses coming in. Oh, great feeling. and then I think is why what we are looking out for as well when we are investing in dividend stocks. So, okay, let me move on to the next group of questions. Give me a second, let me just pull it up. Okay, this is specific to Royston because someone is saying that he knows that you own Keppel DC REIT, right? May I know that do you still own it? And beyond that, I think he's asking for your opinion on data centers being set up or managed by other REITs. So what are your thoughts on Keppel DC, Royston?
Okay, well, I'm still vested in Keppel DC, and I still feel very confident about it. And I think, it's going to have a pretty bright future, because data centers, are the backbone of our technological evolution, I'll call it. And now with generative AI and accelerated computing and all these nice terms, right, appearing in the media. Data is basically like the new oil. Everybody needs data and more of it. So what happens is a lot of countries will start building data centers, and not all the hyperscale data center owners want to manage these data centers on their own. Sometimes they also need to diversify a bit. So what they do is sometimes they also do like a sale and lease back. That's what they do. That's how some of these REITs actually get to own the data centers, and then after that they actually lease it back to the tenant. So I think the runway for growth for any data center REIT, I would say not just Keppel DC REIT, is actually very good, and there's actually good prospects for it. And let's not forget that Keppel DC REIT also has a very strong sponsor called Keppel Limited. No more Keppel Corporation. They've changed their name, incidentally. So Keppel Limited is actually a very good sponsor because it has this huge pipeline of data centers, 2 billion Sing dollars worth that can be injected into the REIT, once these are mature and stabilized. Okay. So I think there was also a question somewhere in there that I saw that, recently Keppel DC REIT had a letter of demand to its tenant, Blue Sea, So we don't think that's a very, very big issue because it's only about 6% of the DPU. So I would say if you look at the long term, it's probably just a small blip, whereas the prospects are actually very good for the long term for this REIT.
Okay, thank you, Royston. The next question that comes in is, if you are only investing in REITs in 2024, what about diversification? I think that's a very valid question. Well, maybe let me talk a little bit about what we are doing at the Smart Dividend portfolio, because earlier on I did mention that we're buying 6 REITs in the first 6 months, right? And then after that, I'll hand over to Royston and Chin to see if there's anything else to add. So, okay, yes, definitely it's important to diversify within one's portfolio. I think in our situation at the Smart Dividend portfolio, we already have 26 stocks that are diversified across different industries. And where we are right now is that we see an opportunity with REITs in 2024, this year. And that is why we are setting aside this amount of money, 10,000 Singapore dollars, as we want to be ready to capture this opportunity to give that added boost to our portfolio. So for existing members who are with us this evening, or even new members who might join us in the coming days, if you may not want to just focus solely on REITs, or maybe you just, for whatever reason, don't like REITs. Interestingly, we had a conversation with somebody who did not like REITs last week. So, but yeah, I mean, Royston knows what I'm talking about. But yeah, I mean, there are people like that. It's just not your cup of tea, right? So we also have a feature within our service called the Top Favorite Stocks. It contains a list of our favorite stocks from within the portfolio, and it gives our members an alternate list of stocks that we like at that point in time, beyond what is the stock buy, or rather the stock that we buy in that particular month. So say, for example, you want to buy more than just REITs, or perhaps REITs, you just don't like it. Like I said, that's perfectly okay. So basically, it's a bit like every month we'll tell you what we're going to eat at this particular restaurant because we really like the food there, but it's up to you if you want to eat that dish or something else. So to give you more options, we're just giving you a list of what we like, what is good at that particular restaurant. So, Royston, is there anything that you'd like to add on?
I would say that, yeah, even though the focus is on REITs, like what Joanna mentioned earlier, we still are open to buying other types of stocks as well, basically non-REIT companies, as long as we feel that their prospects are good and valuations are good as well. So what we do is we do track the business very closely. I look at every earnings report, corporate development, announcement, etc. And of course, if I see something that's really, really good and it's going to positively impact the business, then yes, of course, we will definitely buy that business and not just be focused on REITs alone. Yeah. So that's the diversification there.
I'll just add a few short sentences. Diversification, I think it comes in multiple different levels, right? It's 26 stocks we own. It's also diversification over time, where we give enough time for stocks to show us what they can do before adding to them. That's diversification over time. And we also categorize our stocks by 3 buckets. So there's the income bucket, where there are stocks which are stalwarts, very reliable, might not be growing very fast, but very reliable. That is the focus, right? There'll be a layer of growth where we think that certain stocks are able to grow their dividends faster compared to the income stocks. And finally, for the tip top, there'll be what we call speculative, which sounds very wow, but it's really just a place for us to test new ideas. because I think that certain ideas are maybe high potential but very low probability, very uncertain. So that small little segment, which is guarded very well, where we dedicate a very small amount of money, is to allow us that sort of play space to be able to try different ideas, but yet not overcommit to those ideas. And in time, if they do well, we may move them to the growth or income bucket.
Okay, thank you, Chin. Thank you, Royston. The next bunch of questions. Sorry, I'm trying to look. Here is what are there are like 5 different questions on this topic. So give me some time. What is the REIT that's expected to benefit this year? What sector of REITs do you think will perform well this year? What REIT sectors do you recommend? Do you think that most REITs will be able to grow DPU? And what industry would you look out for in 2024? So really, maybe in general, Chin and Royston, if you can just talk about what sectors are you looking out for, or what sectors do you think will perform this year?
Let me just answer this generally, then I'll see whether Royston wants to do it more specific. I think when you look at sectors, I don't just look at the coming year, right? As I mentioned, my key focus is sustainability. When I say sustainability, I'm looking 5 years out. Now, that was very difficult to do during the pandemic because things were so uncertain, right? But there was a point I made during the IFAS conference is that if you look back at the last 4 years, right? The last 4 years contained a pandemic year, 2020, a year of vaccination, 2021, a year of super sharp higher interest rates, 2022, and then in 2023, you see sort of moderation of interest rates, but then they still rose, right? And also the full impact of the recovery from all the restrictions during the pandemic. And this period was very turbulent. And I think that when you look back, you need to put things into context, right? Because certain things, for example, if you own a mall and it got severely restricted during the lockdowns, there's really nothing you can do, right? You just have to roll with it. But you cannot assume that those lockdowns will continue to happen in the future, right? So that's where, digging into details and what Royston mentioned, right? He's really like for all of the 26 stocks, he's digging into details every month to make sure that there's no problems cropping up. Some problems, they might surprise them. And like a pandemic, for example, who would predict such a thing, right? And these are the sort of things which, for me, it provides valuable data points on the stress test which these REITs have gone through. And I would say many of the REITs have actually, which we own right now, have gone through this stress test. And because of that, we feel fairly confident with them. It's not like we're just going to hands off with them, but on the other hand, we want to make sure that in this new environment where there's rising interest rates and so on, we're watching them really carefully on all those factors I mentioned. And really, that's my focus. Because if you look at sectors alone, for example, final point is that some sectors are doing extremely well now. But for example, hospitality, right? But they're doing extremely well because they had a horrible time in 2020 and 2021 and much of 2022 as well. So whatever they are gaining right now is just a recovery from what they lost, right? So it's not, and then you have to ask the question, over the long term, hotels and so on, are these cyclical industries, or are these industries where you can rely on and generate sustainable revenue? Again, that word sustainable revenue comes into play, right? Because that's always our focus. So I think that focusing on sector, you need to have really good context, because some sectors do well, one are more cyclical and others are more sustainable. Royston?
Okay, thanks, Chin. I guess I'll just add, what kinds of REITs, right? I mean, the ones that I've looked at I have seen pretty consistent demand would be like industrial REITs. Of course, these industrial REITs need to have very good tenants, because the tenants are what makes the REIT strong after all. So if these tenants can actually get through a crisis and they're still fine, we're talking about the big blue chip ones there, then I would say that the industrial REIT should be pretty attractive. Of course, like logistics, for example, is a subcategory. It's also very attractive because of e-commerce trends. And then, of course, we can also look at like Singapore. Retail is doing well as well. I mean, you can see everybody out in the shops all the time. That gives you a hint, as to what I think will do well in Singapore malls. And then, of course, Singapore office is doing well as well. I mean, it's not the same problem as what we are seeing in the US office space, where people just want to work remotely. They don't actually want to come back. But for Singapore office, I would say most, if not all people, have to come back to the office, most of the days of the week right now, after the pandemic. So, I mean, those are the sectors that I think will continue to do well. And there's long-term trends that will do well for these particular sectors.
Thank you, Royston. All right, the next bunch of questions. Let me just pull them up. Okay. So someone is asking, what are the 6 REITs that we're going to buy into? Okay, I can answer that really quickly. You can join our service to find out. The next question is, are you also investing in stocks outside of the Singapore market? Yes, we do have 2 other services that invest in stocks outside of the Singapore market. One is called the Smart All Stars Portfolio, and that is headed by Chin. It focuses on US growth stocks. Another one is called David Guo's Income Portfolio. So it's headed by David Guo, our 3rd co-founder, and he looks at the best dividend stocks all around and is thematic. Okay, let me move on. The next bunch of questions are about sponsors, right? Because we talked so much about looking for good sponsors. So we have questions about that. How about investing in their sponsors? Example, CLI. Is it advisable? Someone else is asking, who are some of these top reputable sponsors? I think great question. Royston, what do you think?
Okay, well, how about investing in the sponsors? Well, the thing about sponsors is that the thing about most of the sponsors is they also develop properties. So the thing is there's always a property development arm where the sponsor needs to be quite heavily indebted, and there's also a lot of delay in recognizing revenue from these developments. And that's the difference between the developers and the REITs. So basically, REITs own investment properties, and they just basically sit there and collect rental income. Okay. So the thing about the developers is that they probably don't pay out such consistent dividends. And if I'm not wrong, CapitaLand Investment Limited only pays dividends like once a year when it reports its full year results. So if you're looking to get dividends more frequently, I think the developers probably aren't a very good choice compared to REITs, which either pay out quarterly or half yearly. As to some of the reputable sponsors, I think I probably answered one earlier when I mentioned Capital Limited, who's the sponsor of Capital DC REIT. CLI, which is CapitaLand Investment Limited, is another good sponsor in the sense that the management there really knows how to configure their malls well, such that they attract a lot of footfall. I mean, I go Singapore Centre very often, and I can see the footfall is always very good, and that's under CapitaLand. Yeah.
Maybe let me put some disclaimers on my answers. When you say good sponsor, right? I think some sponsors are really good at very specific things. So I don't think you can say a sponsor is good generally, right? Because it's quite hard to find a sponsor which is good. Like for example, CapitaLand, I think they're pretty good in local retail, right? And you can see from their malls, the best example I have is Big Box versus IMM. IMM is owned by CapitaLand. Big Box is bankrupt, right? Big Box is actually nearer to Jurong East MRT, but yet it went bankrupt. But IMM is 15 minutes away from Jurong East, and yet it's still thriving, right? That is the difference of a sponsor. But it doesn't mean that it's good everywhere, right? It doesn't mean that I go into China, I'm still good because I'm good at retail. Or I go into Malaysia because I'm a good retail manager in Singapore, I'm a good retail manager in Malaysia. There are some advantages, but I think you want to look at what they're good at rather than just just sort of looking for that so-called good sponsor, right? They're good at specific things.
Okay, yeah, good point. Thanks, Chin.
Yep.
Okay, thank you. Oh, sorry. Okay, well, the next bunch of questions, I'm going to direct them to Chin to answer first, okay? Would you prefer ETFs to individual REITs? In this current climate, is it better to buy lump sum or to maintain a regular savings plan? what is the best strategy to construct a REITs or income portfolio? One REIT from each category, I think, because you mentioned it earlier, Chin, that's why I'm directing all this at you. Should I just buy the STI since there's many REITs in there? Why go through the trouble of buying individual REITs? So I know they all sound very broad, but my purpose in sort of lumping them together is trying to answer as many questions as we can tonight. I just have one comment before I hand over to you, Chin, is that I think that's what we are here for. This session is here for to answer these questions. Plus, also, that's what we do at the Smart Dividend Portfolio, right? Is to show our members how to manage your money, how to build a growing dividend portfolio from Singapore stocks. So really, that is what this service is about. But okay, Chin, go ahead.
Yeah. So the first question, ETF or individual REITs, right? I can answer that question really well because I've done both before. And the thing I worry about when people talk about ETF is they go in with the wrong expectation, right? They go in thinking that the ETF will give them diversification and therefore it'll be very stable. That is not true. Okay, I just showed you the index right from the start of the presentation. The index fell, right? ETF can fall by 10%. And when it falls, you do not know what is happening. Okay, why? There's 21 REITs inside. And then if you ask me, hey, Chin, what's happening to this REIT ETF? I thought stable, it falls 10%. How come? Hey, that is the deal, man. I mean, when you buy an ETF, it's supposed to be hands-off, right? Meaning that you choose not to know. Okay? And you have to stick to that because if you want to know, then you have to dig into 21 stocks. If you dig into 21 stocks, my God, just buy a portfolio. Just get a portfolio of your own, right? And I have to make that point because I myself, I bought ETFs before and I got freaked out by the movements. And then I got really uncomfortable by things which are moving, which I couldn't understand, right? And for some people, it may be fine, right? So I'm not down on ETFs at all, right? I still own unit trusts from 2006, by the way, still own them. I don't sell them because I like to do a lot of experiments. And I think this understanding has to be there because I chose individual stocks because now I know what's happening and I feel more comfortable buying them because I know what's happening. When I buy an ETF, the deal is hands off. I invest every month, I keep that discipline. And that's really important because the investor is more important than a vehicle. If you are active with the ETF, no point. You swing in and out, safe car doesn't help an unsafe driver, right? The unsafe driver will run the safe car into the hills and so on. So it's really important about your behavior. Keep it steady. Don't think so much about what's happening. It's the deal. Okay. Question on lump sum versus RSP. I think that this question really goes back to your experience, right? I would never invest in a lump sum unless I am very confident. And that confidence is built over years, right? And not weeks or just watching the stock price every day. This is confidence which I've watched the management for over years. I know how they behave and I understand what they'll do. And that gives me confidence to add to the REITs. And sorry, I'm taking so long. I'll answer the SDI question finally. I think that the SDI can buy it, but the problem with SDI is there's a very huge segment which is on banks, something like 40%, right? So
46.
Need to be very aware of that concentration. So that REITs component is probably around, I want to say 15 to 20%. I don't know what's the latest number, but it's much smaller compared to the banks itself.
Yeah, I can give the number. I just pulled up my spreadsheet.
Ooh, wow.
So basically, the SDI comprises 6 REITs only that take up 12.1%. So if you're looking at just investing in the SDI, you won't get much exposure to REITs at all. In fact, 46% belongs to the 3 big banks.
Okay, now that we're talking about this, I don't know whether, okay, I have the number, but Royston, you might be in a better position to answer because you're the portfolio manager after all. How is our portfolio's performance versus the STI? I think that will give us the strongest indication of why we prefer individual stocks versus STI.
Okay, wait, let me just quickly pull up.
Okay, it's 11% versus 2%.
Yeah, so actually our total returns right now as of end of last year, I think it's about
Mine was I was using it, right?
12.7% versus the STI is about 2%.
Yep, 2%. And this
Yeah.
excludes the dividends that we have been receiving, which is over $7,000 so far. So that's the reason why we prefer individual stocks over the STI. Okay. I think we have to move on. Okay, I'm sorry to rush you a little bit. But do you have anything else to add, Chin and Weston?
Oh no, we can move on to the next one.
Okay. This one is interesting. Any strong case to invest in REITs for younger working adults with an active income and do not need additional passive income but aims to grow wealth, and thus the objective of investing is for capital appreciation? I think that's a great question. Royston.
Well, first off, I have to say that no one will actually say no to passive income, right? Because, I mean, it's extra money. You can maybe take your spouse to a nice dinner or lunch, but anyway. Okay, so the thing is that I feel that there is still a good case for REITs, because if we look at certain REITs that have done well over years, they've actually seen very, very healthy capital appreciation in addition to an increase in dividends. So, I mean, just going back to Keppel DC REIT's example, I think when it IPO'd, it only had 8 data centers, and now it's like 23. So its portfolio has nearly tripled in terms of number of properties. Its AUM has also gone up by a lot. And of course, its share price has also gone up significantly. I think it used to be around $1. And now it's like, close to $2. And it went as high as $3 before. So the thing is that, this is just one example, by the way. There are REITs who have done well and have seen very good capital appreciation in addition to dividends. So I mean, it's like having the best of both worlds. So why not? I mean, if you're a young working adult, you don't have to just fill your portfolio with REITs, but they can become a good component of your portfolio. And as you get older, this passive income will become more and more important to you, because, I mean, one day we will want to either retire or maybe just slow down.
Thank you, Royston. Sorry, Chin, you had something to say.
Yeah, I'll just say it real quick. I think it's important to know what you want, and sometimes what you want and what you really want may be different, right? When I started, I wouldn't have dreamt of investing in growth stocks, but over time, that was sort of my comfort zone, I found, right? And I think the most important thing is really to know what you want, test it out. You may find that you love dividends because, as Royston mentioned, it's a lot of fun just getting income every month. And sometimes it can also help you. By the way, it doesn't have to be one or the other. You could do both, right? And I've investor friends who maintain a certain portion of their portfolio. Actually, myself also, where I have dividends coming in that gives me income, and then some of them use that income to buy growth stocks. So that could be one way as well, right? There are many ways to. I hate this term, skin a cat. Why would you want to do that?
Okay, thank you. The next question is there a minimum amount to start investing with your portfolio? Okay, well, I think the important thing here is that it has to suit your own personal situation, right? So don't feel like you need to invest the exact same amount. We're setting aside $10,000 to invest in 6 REITs, right? But as we buy our 6 REITs or maybe even other stocks every month, you can choose to follow along with us, or you can choose to invest whatever amount you feel comfortable with. You can scale up, you can scale down, however you wish. There are lessons within the service that can give you guidelines as to how you can adjust the portfolio to suit your own personal financial needs and goals. Right, so take these lessons to scale and scale them however you wish. We are showing you our real money portfolio to demonstrate real life investing lessons. Just remember, any cash that you need to use in the next 5 years should not be in stocks, because we are planning to hold our stocks for 5 years and more, and we do not want to put any short-term cash needs at risk. Okay, the next question is, okay, it's a whole bunch of questions on US REITs. Okay, first one is, what about US REITs from Singapore, like Keppel US REIT? How will it grow this year? Second question is, Do US office REITs have any value? The third one is, what is the future of Manulife US REIT and Prime US REIT? Fifth one is, can you provide some insights into US REIT? So there's a whole lot of questions, but I think that, I'm just looking at the time right now. I would just ask, maybe Chin, would you like to, or Royston, just to talk generally about US REITs and how do we see the sector?
Yeah, so when investing overseas, I think for me, one of the rules I have is if I have something better in Singapore in the same sector and I'm happy with it, I don't see the reason of going overseas to get the same thing, right? Unless that overseas thing is something very, very different, right? For example, buying shares of Apple, you don't have an equivalent to Apple in Singapore, right? But you do have office REITs within Singapore, which I think are much easier to understand and much better established because it's a very compact island where people are able to do hybrid work, right? Hybrid work is a very difficult thing, by the way. We think that it's normal because we live in a small island, but when you go overseas into the US, where people might be staying, 2 hours away from office, hybrid work doesn't work for them, right? It's gonna be either you're in the office all the time or you're working from home and occasionally going down to office. So I think that these sort of differences are things which are very hard for me personally, given that US is so big and each state has their different laws and different sort of intricacies and idiosyncrasies, which I don't feel like I have a better advantage, which is why I really avoid US office REITs, in part because I can find better, much more reliable options within Singapore.
Yeah, I mean, just to add to what Chin said, I have a friend in US who basically commutes to his workplace like 1.5 hours up and 2 hours down because of the traffic. So that's 3.5 hours of commute just to get to the office. So yeah, I mean, that's the reason
why
why
they need cup holders.
Yeah, people really dislike traveling, and it's very difficult to get people back after the pandemic. That's basically the reason why you see the office REITs under pressure.
Yeah, the work from home trend is very different for different countries, whether it's sustained or not. And this is another factor. I think that staying at home, if you have already an option to invest in office REITs, which are pretty good, and I feel so, then why bother with overseas, where less, you run into more risks, and yes, the yield might be high, but is it sustainable? Again, the question of sustainability comes in.
Great point about sustainability. Okay, the last sort of question here, the last question actually is, what sort of yield do you seek in a REIT as compared to stocks? I'm going to direct that to Chin to answer. What kind of view would you want? Especially, maybe look in the context of for the smart investor, if we want to look at adding a REIT to our portfolio, what kind of yield would we want to see from a REIT?
I think yield is just one of the many things we look at, right? The bigger question is, again, sorry to be long-winded, but this is really important for me, the sustainability of that yield, whether or not that yield can grow. I think that really is my key focus, because there's no point, getting a REIT with super high yield, but not sustainable. Then the next thing the yield drops by half or even less, or the stock gets diluted. Then you end up with less than what you have. You may even have to pay more because they do rights issue or whatever. And then you own more of something you do not want, right? That's a terrible place to be in. And I think that sustainably matters for me first. Then after that, I'll look at how much growth it can offer. I might accept a slightly lower yield compared to what a REIT typically offers, which is, I think right now it's probably 5 to 6%. I might accept a lower yield if that yield is able to grow predictably over time. But if the yield is shown to be flat or steady, then I think that I would want a high yield as possible. But again, the key criteria here is always about sustainability. Even once something is sustainable, right? For example, if you know that a stock will keep on paying at least 40 cents per share in dividends, I'm just plucking a number from the air, then the lower the share price drops, the better it is for you, right? But that's on the basis that this yield is sustainable, right? That's your core assumption. Then if that's the case, your decision is very easy, because if the share price drop, then you will be able to buy more because you're getting a better and better yield.
Hey, thank you, Chin. Well, again, we thank you to everyone who is joining us, who has joined us this evening. We hope that our session today has equipped you with valuable insights into the potential of the REIT sector in the coming year. So a recording of tonight's webinar will be sent to your email inbox hopefully tomorrow. But the excitement does not end here. To our existing members, to all Smart Dividend Portfolio members, look out for the 6 REITs that we will be buying in the next 6 months for 2024. Of course, we will not just limit we will not just look at REITs only, but if there are other opportunities, we will keep our options open. To everyone else, we are also thrilled to announce that in just 2 days, our flagship service, which I've been talking about, the Smart Dividend Portfolio, will be going on sale as part of our big anniversary celebration. And this sale features one of the largest discounts of the year. By joining us, you'll gain access to all 26 stocks within our portfolio, as well as a first front row seat on the journey with us to buy 6 REITs in the first 6 months of 2024. So don't miss out on this opportunity to start on the journey of smart dividend investing with us. Take advantage of the exclusive discounts and make our anniversary sale the starting point for your financial success. So look out for the sale invitation in your email inbox 2 days later. We encourage you to reach out to us, whether you're a member or you're not. If you have any further questions, whether is it about our service or what we are planning to do for 2024, and your success in navigating the financial landscape is our goal, and we are here to journey with you every step of the way. And on behalf of the Smart Investor team tonight, I would like to thank each and every one of you for joining us today. Once again, thank you for being a part of the Smart Investor community. Here's to a prosperous and fulfilling year ahead. Good night.
Thanks.
Hi,
Good night.
everyone. Thanks for
Bye.
joining us this
Thanks for
evening.
joining.
See you on the other side.
Thank you. Thank you. Are you set? Are you ready to set sail on a smooth income generating journey in 2024? Yes, we are talking about the REIT sector. It's no secret that the REIT sector has taken it on the chin last year in 2023. So let's rewind a little bit, revisit the roller coaster ride that was 2023. It was a challenging year for REITs. The sector has been battling headwinds from surging interest rates and high inflation. Here at the Smart Investor, our house view is that we see this phase as a temporary setback. With rumors of interest rates hitting their peak, the REIT sector has rallied somewhat, already achieving an impressive 7.4% in total returns last year. So the question tonight is there still potential for REITs in 2024? The short answer is a resounding yes. We firmly believe that this sector could be a game changer for your portfolio. In fact, we are so confident in this sector's potential that we are backing our conviction with action. So here at the Smart Investor, we have committed to buying 6 REITs in the first 6 months of 2024. We are allocating 10,000 Singapore dollars in cash through our flagship service, the Smart Dividend Portfolio. Royston is the portfolio manager of the Smart Dividend Portfolio, and he will be looking out for at least 6 REITs to add to our portfolio, 1 a month minimally, for the first 6 months of 2024. And in our webinar this evening, we will cover why we are investing in REITs in 2024 and why you should too. And more importantly, how to identify REITs with the potential to magnify your portfolio's returns. So there will be 2 short presentations, and then we'll close off tonight's session with a Q&A. So ask us your REIT-related questions, please. Again, before we begin officially, if you like more REITs-related content from us, we have a free mini report that's available for download. Let me share the link in our chat function. So you just click on the link, you can download the free report. You can, there's so much more REIT-related content in that report. Again, this session is recorded and we will be sending out a copy of the recording to you, hopefully tomorrow. You can send in your questions at any time this evening. We will again close off accepting new questions in the last 15 minutes. So I do encourage you to send in your questions early. Just use the Q&A button at the bottom of your screen and type it in. So with that, without further ado, I will hand off to Chin to make the first presentation. Chin.
Hi, everyone. Okay, everyone can see this, right? All good? Okay, I see Benny Tay raising his hand. Thank you, Benny. So firstly, good evening to everyone, and thank you very much for spending a Tuesday evening with us. Really happy that everyone took time to join us today, right? I'll start by giving a brief introduction about myself. So I'm just going to share 3 things about myself, and then I'll get down to the presentation proper. And this for the benefit of people who might not know who I am, right? So this is myself with my 2 co-founders, Joanna and David. Now, you will know David for his love of dividends, which I'm sure he has shared over TV, over radio, and whatever channel there is really.